On today's show, 3 questions. Number 1, what happened in Jackson Hole? Number 2, did we just come out of a flash crash? Number 3, do pumpkin spice lattes affect the stock market? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
I'm Victoria.
And I'm Rabih.
Oh!
I just decided to go first, and I think it might, I just went for it. Yeah.
I was like, he's going to go.
He did it. He did it.
We did not decide the order beforehand. We know. We share the same brain cell.
At this point, we just know. We don't even talk about it. What's better than 3 of us, guys? 4 of us. 4 of us. We have a panel today. We just thought, let's make it a party because we can do whatever we want. So the third question has to do with why we're doing 4 of us today. Victoria kind of bulldozed her way into this one. Okay, not bulldozed. Politely requested to be in this one because of, what is it, Victoria?
Pumpkin spice lattes are back for the season.
They are back for the season.
They returned yesterday, so I can now live again. Life is worth living.
And let me tell you, people, several members of the team, of a DA's team, are elated. There was slacks going back and forth. There's been memes like crazy. Ryan might be the one that's more excited than anybody. He probably should be here.
Yeah, his was in all caps.
Yeah, he was very excited. So, okay, let's jump in, though. Before we get to pumpkin spice lattes, let's talk about Jackson Hole and what happened there. We teased this, Rabih, last week or the week before. The symposium, the Fed's kind of symposium and annual meeting was coming up, and we want to talk about kind of the takeaways from that.
Yeah, like this is the equivalent of pumpkin spice latte in the world of Federal Reserve. It's a very exciting week.
Rabih was actually texting himself about
in caps lock. It was like
it's time, and he's like, I know.
Dear me.
Dear me. It is the Jackson Hole Symposium. I cannot wait to see what Chairman Powell says.
Sincerely.
Sincerely, Rabih.
It was great. Unfortunately, it's not like the DNC, they speak every single day. They only speak on the last day. But once a year in August, the Open Market Committee of the Federal Reserve goes up all the way to Jackson Hole. They lock themselves in a room for 4 days, analyzing our economy, seeing what needs to be done, and then come up with a statement.
Rabih, why Jackson Hole? Is there a reason why? Do you know?
Hey, you ever been to Jackson Hole?
I know, that's not to say we're close to Jackson Hole and it's gorgeous and beautiful
Jackson
and I love it, but
incredible.
that just seems random. But that's okay, cool.
Here's what they claim. They claim they get together for 4 days and lock themselves and do all this stuff. They're really just out exploring Jackson Hole, which is amazing.
I don't blame them.
And then on the last day, they're like, we probably should say something.
Should get something done.
We probably should say something.
Okay, sorry, Rabih. I was just curious.
No, that's fine. I'll have to research why it is Jackson Hole. But Matt, I think you might be right. Because in the Jackson Hole meeting, they do not come with a decision. Like, they do not raise interest rates or they lower them. They don't have authority to do that. It's just a press conference. But the speech is important.
It's a vacation that they just want to write off.
Well, they deserve it.
Yeah.
So, so the last time they cut interest rates was like July, and they won't be able to make an interest rate decision until September. So it's good that they're able to have an opportunity to communicate to the market where we are month over month, even if there's no decision, especially at this, tense-ish time in the market where they know interest rates are going to start coming down, but they do not know when and they do not know to what extent. Well, Jerome Powell made a speech this morning and really laid out the action plan. And I'm just going to quote what he said. I don't think it needs further explanation. But given all the conversations we've had about will they do it in September or not? What is the federal funds rate futures market pricing in? How will that affect elections? All of this will actually make it very clear. So and the quote, Jerome Powell says, "The time has come for policy to adjust. The direction of travel is clear. Then the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. Inflation has declined significantly, the labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our 2 mandates has changed." Boom. Mike.
Booyah.
Am I the only one who's excited about this?
Boom.
This is poetry.
This is poetry.
We got to turn it into a song now.
His prose is just unmatched.
He's dropping bars.
He's dropping bars. Yeah.
So I guess I'm the only one who's excited about this. But the idea behind all of this is that...
He basically said it's time. It's time.
It's time. And the market got what it wanted. It's confirmed that in a sense, it's confirmed that in September they're going to be cutting interest rates unless something very dramatic happens. And the market took this news really positively. We're up over 1.2% on all major indices today. And since the last all-time high that we have achieved, we are less than 1% from all-time high. Year to date, S&P is up 17.5%, NASDAQ around 16.5%, and Dow Jones is around now 8.6%. So we're still in August, guys. We're up 17% for the year. Last year was 25%. It's been a really good run, walking the narrative of a soft landing may be possible. And the last stretch, Jake's face says no, but the last stretch, the last stretch is there. They need to make sure that they can go back to a normal state of monetary policy, not restrictive and not too easing, in order to not tilt the economy into a recession. And it would be in the playbook. They would have achieved a soft landing at that point.
Okay, Rabih just guaranteed a soft landing. I love that.
So we're good. We're fine.
So we're good.
Yeah.
Everyone can feel okay.
Yeah. Did he? I know he mentioned, as you said in that statement, and I saw some articles that came out this morning that a big focus now for them, and we've alluded to this before, that a big focus for them is obviously unemployment not getting too out of control. Like the words he used were unemployment is no longer overheated. I'd imagine the biggest concern now is, do we go from, okay, it's like no longer boiling, no, but we don't want it to get too cold. Like that's probably the biggest risk right now.
100%. So the risk is now, like, will the economy slow down faster than we can cut rates? That's the type of narrative it's in. According to the dot plot by the Federal Reserve since last in June, it looks like it's going to be like 2 quarter basis points this year, and then around only 1% through all of 2025. So we dropped like 1.5 from now till end of 2025. If you look at what the market is pricing, they think that we're going to be dropping like 2%, 2.25 by the end of the next year. Both situations, what the Fed is communicating and what the market thinks, they know that interest rates are going to be lower, and it's starting to get reflected through, yields on the longer end of the yield curve. We're talking about 7 and above maturity points. Like the 10-year interest rate is now 3.8%. So the idea is, will it be the pace that the Fed communicated, or will it be the one that the market is anticipating, which is much harsher? They think that unemployment number will come actually worse, and the Federal Reserve will one day in one of the meetings say, hey, we're dropping by like half a percentage point, or a 7.
So does that mean, Rabih, that tells me that the market is almost predicting a recession? Like the market's almost saying like they're going to be, because the only way the Fed would do that, right, would be if they're forced to, because they're seeing these numbers come in way harsher than they think. And if that's the case, then the risk of recession is way higher than what the Fed is maybe like, meaning is the market's communicating, hey, there's a higher likelihood of a recession here, so we're predicting that, where the Fed's like, no, we still got this thing.
Yeah, but they don't want to put labels on it. Like the market isn't saying recession.
I mean, who wants to be labeled? I don't want to be labeled.
Exactly. So yeah, the market thinks that, hey, maybe stuff will accelerate in a certain direction and you need to pick up the pace, but it does not mean, it just means that unemployment will tick up to like 4.5% or etc. But this doesn't mean that we're going to see negative readings in GDP quarter over quarter. Like it's at this point, what is it exactly that the market is pricing in is the devil in the details. But they think that the Fed has to be more aggressive. The Fed is still sticking to their plan. But either way, lower interest rates. That's good news.
Yeah. Jake, it looks like you had thoughts on this.
No, I was kind of thinking in line with what you were saying there, Matt. My question is, again, I'm not an economist. I am not on the Federal Reserve, anything like that. But do we need to lower interest rates right now?
Yeah, it's a good question.
Like things seem pretty good. Unemployment's really good. Again, travel, hotels, everything, consumer spending, everything is up. The stock market's doing great. All the major indices, as we talked about, are still doing well. I like the idea of, lowering rates sounds good just to make sure we get into the soft landing, but I don't even know if it's necessary right now. And maybe that's why they're still being hesitant and don't want to put a label on it, because they're like, things are still really great. I know economists, they love to predict recessions, but anyway, I don't know. That's just, I'm curious about that.
More of an anticipatory move.
Yeah.
There are two arguments, or like two data points that it would go into that discussion. The first one that we're all aware of is that economic data is lagging indicators. So that's what Matt said. They think it's going to be anticipatory, especially the interest rates unemployment rates moved from the low of 3.5% all the way to 4.1%. Imagine how many people got unemployed just because of the current state of monetary policy. You have to think of yourself as you were running on a treadmill of zero. You weren't really running back in the days, and now we're running on a treadmill with speed 5. How long can you run on a speed 5 before you start getting tired? So just the state of it actually exhausts the economy. The second main argument of it is that in a developed economy like the US has a natural unemployment level and a natural rate level of real rates. And by setting the policy rate, which is the nominal rate, way above that and way above what expected inflation is, you'll just slow down the economy anyhow. So you need to revert back to what the natural rate, long-term rate is. And the Fed has always been communicating that's 2%, 1.8%.
Yeah. One thing I'm thinking about and how this pertains, particularly a part of this, specifically to dentists, but if we're able to come out of this truly without a recession, it's going to be pretty wild. Because if we're going to not count, which you could argue one way or the other, if you're going to count COVID as a true recession, I'm not going to say, I don't think it was like a true natural market cycle type recession. It was really just a flash in the pan from this crazy black swan event. Rabih, if we're not counting that, when's the last time? Was it 08, 09? We were in a true recession?
Yeah.
Wow.
Which is wild if we're able to come out of this without having a true recession. And if you think about dentists out there, what this is going to mean for specifically the dental market, cost of capital is already coming down. We're already seeing this. Jake, I talked to Taylor last week. Victoria, you're seeing this with our clients of like loans that, dentists are now starting to get term sheets on. We're down into the 5s pretty safely on purchases and things like that. If that continues to come down, what is going to happen, specifically in the DSO market, which despite what brokers will tell you, despite what these people trying to sell you on going into a DSO will tell you, the DSO space has been pretty dormant overall, especially on recaps. But if cost of capital comes down the way it is right now at a decently fast pace, just wait. These recaps, these offers, it's going to get wild over the next couple of years. I think 2025 could be a crazy year for the DSO space and just expansion of dentistry in general, because now you've got, again, maybe there's a dentist out there thinking they've been holding off on going to their second location because cost of capital has been higher. Like just the expansion of the business of dentistry is heavily impacted by this too. Real estate as well, right? Buying your building or buying a home. I think the real estate market is going to go wild.
That's the hard part of it. I know home buyers are out there like, yeah, rates going down is a great thing. I'm now finally going to go move and get a house. But the thing is, when rates go down, those house prices are going to go up. Right. And so it's probably a wash for the overall cost of getting into a home. Because, yeah, there's so many people out there who are like, I have a 3% rate on my current mortgage. I'm just waiting for rates to get down to the 5s or maybe high 4s. And then I am going to move. And that's just going to increase demand, which increases the house cost. And so that's the, I guess, unfortunate thing for home buyers out there is, yes, your lending costs are going to go down, but the overall cost of getting into a home, I would predict would stay relatively similar to what it is now.
Yeah, I'd imagine that too. The interesting thing is with rates going up, it impacted so heavily the inventory because nobody was selling that it actually kept prices pretty stable. So I do wonder.
We could get more supply, more houses.
You could get more supply. So I wonder if prices actually stay relatively stable. But the issue is, I guess, as a baseline, inventory in the US for homes, for single family homes, is still just low. So that is always going to be there. So my guess is you're right, Jake. I think rates going down, not only the psychological impact as well. The psychological impact of rates going down is just going to, I think, create prices to go up. So I still really do feel bad for first-time home buyers. It's a struggle for sure. So that was a tangent. It's a little bonus round that we got there. Anything else, though, that you guys want to add to any of this?
Well, one quick question, Rabih. How often are recessions supposed to happen, or do we expect them to happen?
There are a lot of academic research about real business cycles that come from changing, consumer demand, etc. And it's usually a cycle lasts between 8 to 12 years. This is what
So we're like
Academia says.
long overdue, basically.
However,
Depending on if you count COVID, because
Yeah.
that technically was a recession, depending on how you feel about that.
Yeah.
Yeah, sure. Okay.
However, most of these studies have been done in hindsight. Like they knew what economic policy was set in place back then, and they knew how they reacted to be able to identify when the business cycle started and when it ended. Are they just looking at like real earnings, or are they looking at household net worth, or are they looking at GDP and they're deciding based on that? So all of these are very static studies where they assume that policy isn't changing and we are not changing the way we react. And actually, since the end of the 90s, where there was a liberalization of financial markets, etc., the rate at which recessions happen has been slowing down, just because we are able to fix stuff that we never used to fix before.
That makes sense.
So that's it. Yeah. I got you guys why Jackson Hole is in Jackson Hole.
Oh,
Hit
If
us.
you guys want to know it. Okay.
Yeah.
The event is held at a vacation destination, Jackson Hole Lake Lodge in Grand Teton National Park in Wyoming, Teton County, during late August. It was held in a few different locations in the late 1970s, but Jackson Hole has been the location since 1981. The conference was placed there partly because Paul Volcker, the then Federal Reserve Chairman, wanted to benefit from the great fly fishing in the area.
Incredible.
Okay.
See, I told
Something
you.
like that. Yeah,
I
it had to be
told
something
you.
like that. Yeah.
So I'm saying they're like, Jackson Hole's dope. Let's go hang out in Jackson Hole. I don't blame them. It's amazing. If you have not
It's
been
awesome.
to Jackson Hole, summer
Ugh.
or winter, it is incredible.
So
Yeah.
beautiful.
It's incredible. So, okay, that was awesome. Moving on. This kind of goes along with what we've talked about before. And then also it kind of in conjunction with what we're talking about with the Fed and all the volatility and stuff that's coming from that. But Jake, question being, did we just come out of a flash crash?
Yeah, you know how when we talk about the stock market, like stock market principles and lessons we can learn, we often use data or examples from like 30 years ago or 40 years ago, where we use these big, long 100-year data sets to help, prove these principles or to demonstrate principles of how the stock market works and how it
everybody rolls
functions.
their eyes. They're just
Yeah,
like,
I think-
okay, we've heard
Yeah, I
it.
wonder if sometimes that can kind of be like we're disconnected from that. Like, sure, that happened 30 years ago, but what about what's happening right now? But I think sometimes what's cool about the stock market is we can get, like, the stock market will teach us lessons in the short term. Like, we can learn things over the course of a month or 6 months that I think is really interesting. So I want to go back just over the past couple of weeks of what's happened in the stock market. And I think there's a couple lessons we can learn just on how markets behave and how we should react to these things. So I know on 2 Cents, you guys covered the kind of the big dip in the stock market we had a couple of weeks ago. If you, just a refresher for everyone who may be listening to this for the first time, the stock market on August 5th, I think it was a Monday, it like opened up down 4% or so. The market opened up down 4%. And that was like overall the market from its all-time highs in July was down like 8-ish or so percent, 7 to 8%. And so this Monday, August 5th, people were kind of freaking out. I remember there was quite a bit of panic online. I got a few texts and things from clients like, hey, what's going on? What's happening? I hear everyone's panicking to this, 7 to 8% drop that we had. And again, this Monday was kind of scary.
And when you said text, you meant emails, right?
Of
Yeah.
course. I meant
Yeah.
emails from my
Yeah, of
clients,
course.
100% talks.
Totally.
Which again, I'm happy to get those. Those are great. 2 thoughts on this I just wanted to bring up. My first one is, I don't want to get in, you guys already got into the details of why this may or might have happened, the panic and things there. I think this was a bubbling over of a lot of times people are waiting for a recession or bad news to happen. Or I think it's a lot of like AI bubble or inflation or elections coming up and all this bubbles to the surface when you have a dramatic drop, like 4% or so in one day. Anyway, my first thought was I was kind of perplexed by the media mania around it or like the online discourse about this. My main reason being was a 4% drop in a day is kind of ho-hum, right? Like I know people were freaking about, or even the 7 or 8% drops. Context for this, I want to give some historical background. Did you know that in 94% of all trading years, going back 100 years, the stock market drops at least 5% within a year? So I'll repeat that. 94% of all years, the stock market drops at least 5%. So pretty much every year. Intra-year. Pretty much every year we can say the stock market is going to drop 5%. And about 70% of all years, the stock market drops 10%. And we didn't even get to that point, right? We kind of got a 7, 8% drop. But in 70% of all years, the stock market drops more than 10%. And so I think it was interesting. My first thought on this is there's a lot of panic. There was a lot of freak out when this is a normal occurrence in the stock market. And anyway, this has led to my thought of, this is why it's kind of dangerous to be online and to hear market news, is they're trying to take advantage of this dip. They're trying to get clicks and engagement and do all that. and it can be tough. I had one client say to me, like, I kind of went through the numbers with him and stuff, and he's like, it's interesting that so many people are freaking out about this. I didn't know that this was just a normal thing that happens in the markets. And anyway, that's my first lesson. I don't know if you guys have thoughts or comment on that at all.
I've got thoughts. Looks like she's nodding and has some thoughts.
Yeah, I think with our clients, we're really good about setting expectations when it comes to the markets, far better than other firms that I've been at. Like when we talk through an investment portfolio and the level of risk that you're taking, I feel like a common phrase we use is, you can expect the market to dip, 10% as often as your birthday kind of thing. We always relay it back to what you're going to experience, what you can expect to see, so that when this happens, which is a very normal occurrence, it doesn't freak them out. We aren't at risk of messing up or tinkering with the investment strategy. So I think it's a really good point, Jake, to say, this is normal, but media is going to harp on this and try to cause panic, because that's a lot more exciting than, it's a normal day stock market, right? I mean, we come up with spicy questions at the beginning of this. We do that for a reason, right?
Yeah, I to that point, Victoria, I guess we often say, like we're saying on the show, we say in client meetings, we're trying to always harp on this, like, this is normal, this is normal, this is normal. But also we understand and we have empathy for when those moments happen.
Oh, yes. Yeah.
Like, we get this. It's painful. It's scary. It's like the whole Mike Tyson quote, like, you have a plan until you get punched in the face.
It's never fun to see your portfolio balance drop.
Never.
No matter how much it's 1%, 5%, 10%, it's never fun to see it go down.
Yes. And so, not to mention, when you have the media who preys on this stuff because their motivations are different than yours, their intentions are different than yours, like their incentives are different than yours. No one in the media would have a job if they came on and said, hey guys, totally normal.
Yeah.
Nothing to see here.
Well, you just sound naive when you say that, even though you're not.
Yeah.
If everybody else is panicking and you're fine, then you almost look like really naive.
Yeah. Well, I saw an interview one time, and this has been alluded to by other financial writers. Now his name is escaping me. Rabih, who's the crazy guy who smashes Uggs and he's like does the marketing commentary? Kramer. Yeah. His name eluded me for a second. So Jim Kramer was interviewed one time about his bombastic, aggressive, sensationalistic approach. And his response was something to the effect of, listen, I have 17 hours to fill, like, every day. Like, he's literally he's like, the financial media has hours to fill. We need eyeballs. He was fully admitting it. Like, this is what we do. And so we will continue to remind people of this. Like, you want to be a better investor, turn off the news.
Yeah.
You want to be a better investor, stop. Your ability to, like, your returns are directly related to how frequently you check your portfolio. You stop checking your portfolio, you turn off the news, I guarantee you, yes, I will use that word, I will guarantee you will be a better investor. So
love it.
I love that, Jake. Like, this is normal. Putting this in context with recent history, not going back to like 1928. We're saying, like, this just happened.
Yeah. So that's my first lesson here is, again, to what you guys are saying, is if you're going to be a long-term investor, I hate to break it to you, but you're going to have to sit through 5% and 10% dips in your portfolio often.
A lot.
Almost every year.
Feature, not a bug. Yeah.
That's a good message to all maybe newer investors out there, is just get used to it. That is the price you're going to have to pay for long-term returns. That's going to happen there. What's interesting?
Let's get Rabih in here. Just
Rabih.
totally?
No, that's fine.
We're talking investing, and we just leapfrogged Rabih.
Yeah.
If you're in, honestly, this is a psychological trick I use on myself. Like, if my time horizon is 30 years and I really do not care about what's happening in between, because I know in 30 years my probability of success is very high, then every 5 to 10% dip that I see in the market makes me get excited to buy more. This is my opportunity to buy.
You're buying shares. Yeah.
Love it.
Yeah.
To that point, that leads to my second lesson here, Rabih, that I wanted to get to. So August 5th, that Monday, I think that was a low point in this dip. Again, the market was down like 7 to 8% from the highs in January. Well, in the intervening weeks, there could have been, it would have been logical for some people to think during that day, like, hey, the media's freaking out. This could lead to a big recession. Maybe I'm going to take my money out of the market. I'm going to sit this out. It seems like volatility is on the horizon. That would have been a normal take to have. But now with the benefit of hindsight, we can look back and see what's happened in the past couple of weeks since this crash. Well, what's happened is the market gained back all of its losses in 4 days. Every single one. So that whole 7 gained back in 4 days. Over the past, as we're recording this, it's been like 2.5 weeks or so since that point. The market's up. It was up like 10, 11%. I think we're back down to 8, 9% kind of from that low point. Anyway, we've had like a 2-week stretch of almost 10% market gains since that low, which is huge. If you think about like 10% gains over the course of 2 weeks, that is a massive return over this time period. And if you would have been skittish or scared or nervous and taking your money out, you would have missed a really big opportunity to grow your money. And this is what happens in the stock market. Oftentimes, those days where they have really big lows are accompanied by the days that shoot up here. And we need these best performing days. You need these best performing weeks to have a good return overall. Like if you missed out on this 10% gain over the past 2 weeks, that's really detrimental to your portfolio. And so this is just one of those instances where in a 3-week span, we kind of got a good stock market lesson of the market dips and that's normal. And it also recovers oftentimes faster than we think.
Well, and to that point, to Rabih's point, that goes perfectly with what you just said, Jake. If you shifted your mindset, and we know it's easier said than done, we get that. But if you started to get excited by this stuff, as someone who's investing over the long term, we work with most of our clients are in mid-career, mid-ish career, and they have a long way to go, and they're accumulating shares. If you shift your mindset from away from this idea that, prices are down, that means my portfolio's down, to Rabih's point, it's no, the name of the game is how many shares can I accumulate in this thing, in all these investments. So when prices are down, everything's on sale. Let's go buy. Like, you should be excited by that. You shouldn't care. In fact, if you really think about it, if you are an accumulator, if you're putting money into the markets on a regular basis, let's say you're 40 years old, you don't want prices higher at the end of the year. That's actually a bad thing. So right now we're sitting here saying like S&P is up 17% year to date. That's not good for you. That's not good if you are a 40-year-old and you're putting money into on a regular basis. You want that to be the opposite. You want to be, and I know that sounds weird because you're like, well, my portfolio's down. No, you are able to buy so many more shares when those prices are down. If you got 20 years to invest, you want a 5 or 6 year stretch of negative returns because you're able to buy so many more shares.
It's on sale. We love a good Labor Day discount.
You're saving money just like you are when you're buying things on sale at H&M, right? Victoria's got it.
Oh yeah, 1,000,000%. I had a Amex $10 off, $100 at Lulu. I made $10.
You literally saved money. Yeah.
No, I made money.
No, you made money.
Right.
Hashtag girl math. Yep. Jake, sorry, go ahead.
No,
Jake.
that's good. The ending point is volatility is going to happen. Ben Carlson recently posted a statistic where he said he did the average of like all the up years in the stock market, what's the average return, and of all the down years, what's the average down return. And when the stock market is up, the average percentage return it's up is 21%, actually, is the average up year in the stock market. And the average down year is 13%. It's kind of the average. If we have a down year is 13. So what that says to me is that the market's actually, it moves up and down more than we even think or anticipate, right? These 5 or 10% crashes are normal. In the up years in the market, like this year, right? What did you say, Rabih? We're up about 17%, the S&P 500 or so far this year. That's pretty normal. That's pretty average. And then our down years of, 10, 13, 15% are also pretty normal there too. So yeah, I bought when the lows, actually on August 5th, that Monday, I put money in my portfolio. That is not because I am smart or timed it right. That is because Dentist Advisors, we get paid on the 5th of every month. And just every month, I just automatic money going in. And that's how I would recommend people doing it. It's just if you just put your money in consistently, you will take advantage of these opportunities.
So you don't have to say you're smart. I'll say I'm smart because we pay you on that.
You paid us exactly on that right day. Sometimes it works out nice.
Exactly.
Yes.
I'm just a different level here. I'm playing chess. You guys are playing checkers.
Yeah.
Rabih, I want to give you final word on this since, again, this is an investment discussion. Any other thoughts on this at all?
No, I just want to re-highlight the idea that when big crashes happen, big returns also happen. That week between August 7th and August 14th was the best week for the US stock market in the whole year. And that's simply because it was 2 days after a big crash. So keep that in mind. It's very hard to time going in and going out, especially around volatile markets. But the easiest thing to do is just to ride the wave throughout.
Don't time. Don't think you can time. You can't, people. PSA, you can't. Okay, Victoria, any other thoughts on that at all?
Okay, and this might
She's
be
like, yes.
I mean, I do, and we can go from PSA to PSL in a second. But one last question that I have is, how I feel like we always tell people like, don't freak out, like don't do this. But I always like to tell people, like okay, well, what do I do with my hands? You know, like, what do I do? Because we're always saying stay calm, right? But Rabih, like, what would be something that would be of a concern, right? Because we're saying, you know, this is normal. And again, this might be a whole other podcast, but what would be a reason to be concerned? Like, even one?
Actually, yeah. Any blip in the market has the potential to be a catastrophe. I'm just going to start by there.
Okay.
The issue we had on August 5th was due to the carry trade that happened in Japan. In Japan, it was kind of a catastrophe. The stock market on that August 5th that Jake is talking about, stock market in Japan dropped 12% in one day. And the next day exactly, it recovered 10% of those 12 that it crashed. So it could have been a catastrophe. The thing is, when the US markets opened, due to the trading activity that's available in the US and other opportunistic investors that thought that Japan is now at a discount and they need to go in, they were able to absorb the shock. And as the shock was absorbed, markets, recovered, and that bouncing back dissipated away. So whenever there's an intervention, whether it is through market forces, such as the market being efficient and taking the opportunity, or policymakers intervening by, I don't know, COVID issuing a stimulus checks and the Federal Reserve creating currency swaps and lowering interest rates, whenever there is, a positive reaction that the situation is becoming contained, that this is not going to continue to become a catastrophe.
Okay.
But whenever stuff get out of control and we do not know what to do, then it could be a catastrophe. During COVID, financial markets did not face a catastrophe, but our lives faced a catastrophe because we were lost between going out or staying in and putting masks and not staying masks. The fact that you didn't have a prompt response to contain a situation blew it in our faces. And it's all human nature. So when something happens in the market and the market can't control it because we don't have the proper regulation or it's too big to fail or whatever, that's a problem. But every single blip might be a catastrophe, but I think we've got the proper infrastructure to handle 95% of those.
Okay. No, that's helpful because we usually say, don't freak out about this, don't freak out about that. But what can I reasonably freak out about then?
I think it's a great question. Yeah.
Because we always form it in the negative and it's like, okay, well, when am I not crazy? When is this actually a level of concern? I like to kind of flip the
Tell me when I can freak out.
I think it's an awesome question.
What do I do with my hands?
I actually think you can. Like, my advice to people will be like, no, freaking out is fine. Like, if you want to get scared and nervous, that is natural, human. That happens to me, to all of us.
Feel your feelings.
But honestly, this is like very therapy, like feel your feelings and let them pass through you, type of stuff. But I say, like, yeah, it's fine. I like when my clients call and we text and we can talk, email, and we can talk about, things and go through that. I think it's great. Just one quick point. I think most of the time in the stock market, again, there are going to be ups and downs. Sometimes the stock market goes down just because stocks went up a lot before, right? That's just kind of how things have to go. There has to be contraction things. But I would say, like, we do want to make sure, like, we are paying attention to what's happening in the markets. And we want a lot of when we need to change things or when we need to have concern applies to not what's happening in the stock market, but what's happening in your life, right? Are there specific things in your life where we need to change your allocation or get out of certain investments or get into certain investments? Will happen as you reach different maybe career stages or life stages, or things are happening in your life. And so I just wanted to answer it that way of, like, yes, I think, like, we're always monitoring this stuff. We're not saying just don't worry about anything. But a lot of times I think we want to change strategy based on your life, not on what's happening in the global economy.
Yeah. Go ahead, Rabih.
Just last point, because I really liked what the question Victoria asked. Warren Buffett.
Oh my gosh, thank you guys.
Warren Buffett in most of his meetings quotes Ben Graham's Intelligent Investor book. And he says that the market is like that guy that sometimes acts irrationally, and you should be there around when they are acting irrationally to, abuse it, in a sense. That's the thing.
To abuse him, yeah.
But if you want to make like a Gen Z analogy of that, if like the stock market was your best friend, it's the best friend that is always freaking out. It's the best friend that is always overreacting. But then when stuff happens, you go to them and you tell them, come on, you should have believed in yourself. It was nothing. Like, this is if the stock market is that type of person, just believe in yourself that you've got proper infrastructures, proper policies, proper legal system behind it, that it's going to work out at the end of the day.
I'm triggered. You're explaining me.
Yeah, I love this. That's a great analogy. And Jake, I loved your point of saying, to reemphasize this, that we do not take the approach internally at Dentist Advisors. We manage a lot of money for our clients. We do not take the approach of set it and forget it and never ever make any changes to anything ever. We are not of the approach of buy, just again, set it and forget it, buy and hold. We're not saying that's necessarily a bad strategy. We're saying there's better ways to do it, and why we have Rabih and our investments team here we are constantly monitoring things and making changes as needed. I think our main point here always is don't make wholesale changes via selling out of something or whatever because of fear of like this blip. So I think it's a really good distinction that you made there too. Okay, that was awesome, guys. I'm so glad that we went down that road. And we go on these tangents, but a lot of times I hope that they're helpful.
They're better than our original topics.
Better than our original topics. Exactly. Okay. I'm also happy that I was off the hook of a topic, and I'm really glad that I didn't prepare a topic myself because we have had so much good stuff from this. Best one. Best for last. Did pumpkin spice lattes affect the stock market? Victoria, tell us, do they?
No.
I thought you were going to say yes.
You just wanted a reason to talk pumpkin spice lattes.
You guys, I know I always come on here and say, don't believe the media. They're trying to freak you out. I am also trying to do the same thing and just spike your cortisol for the first 2 seconds of this podcast.
Oh my gosh. I love it.
Hey, I know it works.
We are part of the problem.
We are part of the problem. I'm talking about lattes. I'm not talking about selling out of your portfolio. So it's harmless.
It's true.
So
I thought it would have a big deal because I'm not a coffee latte drinker. That's kind of not my jam. And I probably look down on some of these trends and things, even though I shouldn't. But I do acknowledge that like it is a big deal. Like I don't underestimate the big deal. But so I would assume that it has some sort of impact on the economy or something with these new wave of everyone going to get their new lattes. It's got to be a big deal somewhat, right?
At a minimum, it's got to have an impact on Starbucks.
Yeah, I might be getting a little ahead of myself here. This year was a little bit unique because they pulled Chipotle's CEO. And so their stock price shot up. What was that, Rabih? Like a couple of weeks ago?
Yeah.
They were super excited about taking Brian over. So
Brian, they brought Brian over.
They got Brian over.
They got Brian.
Brian
got caught up in the extra meat controversy at Chipotle. So he was looking for a way out. And he thought, you know what? I'm going to jump on the Starbucks train right before PSLs come out again. It's like the perfect momentum move by him. It was perfectly timed.
I really think so, because he kind of like, I don't know, this might have been like a month or two ago, but he kind of went big on TikTok because he was responding to the like Chipotle controversy that they were not giving you as much protein, which really upset Matt there for a second.
It was a rough couple of weeks.
It was rough. So Brian Carroll came on and basically, you can find this video, but he basically said, if you just give him a little look, we'll give you a little more.
It was the weirdest video. It's the weirdest video.
Yeah. Oh, a little look for a little more, huh?
Yeah,
okay. That's the policy.
It was a weird video. And the comments, which are totally accurate, is like, this man has never stepped inside of a Chipotle. Yeah. Yeah, so tell us about the pumpkin spice impact, or so you're saying there is no impact to the stock market. That was a sensationalistic headline.
Yeah,
we are part of the problem, but
well, no, my hypothesis was, they have this seasonal beverage to help boost sales, which that's true, and I thought that would be reflected in the stock price. Shares closed 0.4% lower on Thursday, so it was.
I love that.
I don't. I mean, I thought.
We're just talking market lessons here. That's great. Like this, how hard it is to pick this stuff. I think that's a fantastic, like everyone, that seems like a reasonable assumption. Stock price is going to go up as everyone's buying their lattes, but nope.
No, that's very fair. Sorry, that was a little aggressive of me.
It does suck for Victoria because she times her investment specifically around pumpkin spice season.
Yeah.
So she's literally sold out of everything in her portfolio and bought Starbucks. Mm-hmm. So she's a little disappointed right now.
Yeah, that's exactly what I did. No, I mean, I think it's good because, I mean, I don't know if you guys heard people say this, like investment strategy, like buy the companies that you believe in their brands, or you see people wearing their brands, or the pumpkin spice or a pumpkin spice latte, that type of thing. And that doesn't always work, Also thought, that was my hypothesis going into this, that their stock price would surge, 57% yesterday, but it didn't. So, there you go.
But what will be interesting for real is to see, I know you've got some numbers here of like the foot traffic and what the impact it has on sales. It will be interesting to see what it does to earnings, because like from a fundamental aspect, I don't know if we're even necessarily saying, what is pumpkin spice latte? I love that we're talking about this. Like, what does it do on the day of the release versus what does it do like the next quarterly earnings report? Yeah. I think that would very much have an impact, or could have an impact on the price.
Yeah, definitely. I think I saw an article like that talked about if you'd invested $1,000 in 2003, August 2003, when the pumpkin spice latte was born, that would be over $16K now. So
Wow.
That's not, exclusively because of the pumpkin spice latte. I'd like to think so, but
We should, if you're out there listening, if you're still listening, this could be a drinking game that every time we say pumpkin spice latte,
Pumpkin spice latte.
you take a
and
sip
if
of
you're
your,
not on your way to go grab one at this point, what are you doing?
Isn't it a little early? Have people brought
Yes.
this up? I mean, it
Yes.
feels like it's still summer. It feels like
Well,
this
this
should
is
have
all
been
Brian.
introduced. Oh, it was. Okay.
Yeah, so Brian
Okay.
comes in a couple weeks ago, and I think it was largely like his choice to release this early. So this is the earliest the pumpkin spice latte has ever been released. I'm still laughing at why did I talk about this? This is the earliest that the pumpkin spice latte has ever been released, and it feels like every year, every couple of years, they just push it earlier and earlier, which I don't mind. I think that's amazing.
We'll be getting a May release here in a couple of years.
I want it to be
limit.
what?
There's a limit.
I know it feels like now is early. I mean, it does not feel like fall yet. It feels still we're in summer.
I don't
We're
know.
like football season is starting. Football season is starting, so I'm fine with it being close to the opening weekend of college football.
Yeah.
But if you go a much earlier, I'm with Jake. Like one of my biggest pet peeves with society, and my kids push this sometimes, they're wanting to wear Christmas jammies in June, and I'm like, no, this is not allowed. This is not allowed. So you push this much further, and I'm probably going to have to, start picketing.
Okay. Well, I'm happy with it. I wish it was year round, but unfortunately,
it wouldn't be as special. The scarcity is a good thing. Right. It's not as special if it's
exactly right.
Yeah,
scarcity makes it special.
A few of us in the office all went yesterday together to go get pumpkin spice latte, pumpkin chai, and a pumpkin cold brew. And then Ryan remotely got his cold brew.
Yes.
So yeah, you're right. It makes it special.
It makes it special.
Okay, so shall we get into some stats and some fun random numbers I found?
Yes.
Okay, so 21 years of the pumpkin spice latte. Amazing. Foot traffic. So 2019 foot traffic jumped 14% in 7 days following the launch. So I'm curious to see what we'll see this year. And then in 2022, that increased to 25.7%.
That's wild.
Foot traffic. So I don't know. We'll see how it goes this year, but it does help boost sales. And Starbucks has been struggling with consecutive quarters with their sales. So I think pumpkin spice lattes will save the day.
Okay, this is crazy though. Sorry, I did jump into your notes.
Gosh, you're always doing that. Don't steal my thunder.
They're shared notes, okay? But I don't know if you were going to share this. It sounded like you were wrapping that up, but July 29th, 2023, the business of pumpkin flavor itself is worth over $802 million.
Mm-hmm.
That's kind of wild.
Yeah, it was a guy named Peter Dukes, I think, that birthed the pumpkin spice latte. And it was really because of him that Starbucks started this all, and then Dunkin' got into it. And now Wendy's does stuff. You know what I mean? All the other stores now do this because it's such a lucrative market. And it's funny because pumpkin itself doesn't taste like anything. It's cinnamon and nutmeg. You know what I mean?
Yeah.
Pumpkin's bland, but
well,
it's an $800 million market.
We had the documentary from Nike, about Jordan, and I'm waiting for now the documentary.
You're so right.
On
I'll
this.
produce it.
So, yeah,
don't compare those two. That
Director, producer.
No, never. Rabih, I know you've got some final thoughts on pumpkin.
Yeah, I was Googling when you guys were talking. So my sources might not be as credible as I usually provide. It looks like seasonal items, season staples, including pumpkin spice latte and other stuff, account for only 10% of Starbucks revenue.
Oh, interesting.
So I don't think the stock will move that much simply because of an item that is around 10% of your revenue. That is the first point. The second point, do you guys know what percentage is Starbucks out of this S&P 500? So if Starbucks doubled overnight due to the pumpkin spice latte, how much would have an impact?
What does their market cap take up, and what percentage of their market cap is of the S&P 500?
Yes.
I bet it's low single digits.
Just give numbers.
0.5%.
0.5.
I'm going to say 3%. 2%.
Victoria.
I'll go 1.
All right. It's 0.22% of
Whoa.
the size. So if Starbucks doubles overnight, which doesn't happen, especially in June when there's no pumpkins around. So if it happens, the S&P 500 will go up 0.22% for the day, which is noise.
in the world of the S&P 500. So as much as it affects our lives day to day, I don't think it affects the stock market at all.
Which is great. That's a
Great point.
That's a reason for being diversified, because on the other end, if it does end up fail and Starbucks sadly goes away, it is not affecting your portfolio as much as you would think. That's the benefit of being diversified there.
It's a
If
great
that
point.
ever happened, we would have to break into a Starbucks and steal
We'd
the
have
pumpkin
big problems,
sauce
but our
because
portfolios would
I
be fine.
cannot
Yeah.
live.
Life
Yes.
problems would be bad.
Life
Portfolio fine.
problems, yeah,
Yes.
go
Yeah.
exponentially up.
I know we're joking and we need to wrap up the pumpkin spice latte segment, but that's a great point of like the impact it can have on your life, like the excitement it can be in your life or the impact versus your portfolio. Those things are very disjointed on
Yep.
both sides of it. So I think that's a really good point. Victoria, final word.
Go get yourself a PSL. It's not here for that long,
There
so
you go.
enjoy it while it lasts.
There you go. If you too are excited about pumpkin spice lattes, let us know. Let us know in the Facebook group. Let us know if you like them, you don't. That was awesome. If you need any more evidence to know that there's no topic that is off limits for us, look no further than this. We love all of these things, and we will always bring them back to an analogy around investing or making smart money decisions. So this was awesome, guys. If you are still listening, we appreciate you. Jake, Victoria, Rabih, thank you so much for being here. I think we're going to tease this. We're going to do the same thing, but about football, because let's be real. Again, pumpkin spice latte is also football season, also signals football season. College football this weekend. It really kicks off next weekend, and then NFL. It's the best time of year, people. It is the best
It
time
really
of year.
is.
Yeah, we love it. So maybe we'll do something about football next week. So as always, that was our 2 cents. Till next time, have a good weekend. Bye-bye.